Hi everyone, it's Atuksha from Simple Crowdfunding, and in today's interview, I'm here with the lovely Faith Locken, who works at JLL in the capital markets team as a surveyor. Hi Faith, how are you doing?
Hi, Atuksha. I'm good. How are you?
I'm really good. Thank you so much for joining us today. There's a lot of talk with regards to valuations and a number of other things. And I was
Mhm.
really keen to pick your brains with regards to what you're seeing in the marketplace. I am absolutely going to ask you to introduce yourself, but just for the audience, I
Yeah,
just want to make sure that you understand this is not about providing advice in any shape or form. This interview is understanding what Faith is seeing when she goes out to conduct valuations. So thank you so much. I really appreciate it. So Faith, introduce yourself.
Hi, everyone. My name's Faith Locken. I am a commercial surveyor. I work at JLL, which is a global real estate advisory firm. As surveyors, there are a number of different areas in surveying. I particularly work in our capital markets team, which is essentially our investment team. And I'm specifically based in the city. So we buy and sell office buildings. So if you think anything in sort of the city square mile, that is our patch. And we provide advice to our clients who are usually kind of institutions or, high net worth or investors, both foreign and national investors. And we provide them with our expertise in the investment market. So a typical sort of, I don't know, day in my life as a surveyor would be um, understanding a client's requirement in terms of returns, what they want for return on their investment, and then going out to the market and looking for deals that meet those requirements. So we would run what we call a financial appraisal almost on each property. So it's somewhat of a valuation essentially. If you think about how a regular investor would analyze a property deal, it's on that kind of same level, but we look at it on a cash flow basis. So we're analyzing the deal over sort of a 5-10 year period, as opposed to just sort of what the value is today. And so what we've seen, I guess, since this whole pandemic has happened, rightly so, a lot of investors have held back. So there's not many investors going forward to purchase. The debt markets were a bit uncertain at first as well. So a lot of the investors that buy the properties that we sell, which are sort of in the millions, I
Mm.
say sort of like 50 million upwards, a lot of them will be using debt to leverage. And therefore, as the debt markets were like, shutting up shop, valuers weren't going out or were unable to go out because of lockdown to carry out valuations. So everything kind of came to a standstill. So that's kind of what we've been seeing. But I think now, as agents are kind of going back to work, we will see, particularly if there is going to be a recession, which is pretty much forecast, we'll see a lot more investment and money coming into the capital, I think, to sort of buy up and get good deals essentially on the back of this pandemic.
That's really interesting. I'm going to come back. There's tons of points you've raised there, and I'm going to come back to those in turn. Where I want to start is one is understanding your property background as well, and how you sort of weave that into your valuation work and
Mm.
how it in turn helps customers. So can you talk to me a little bit about that?
Yeah, so I started at JLL about 5 years ago. I was fresh out of university, a graduate. So I was doing a part-time master's in real estate, finance and investment, whilst
Mhm.
also training to become a chartered surveyor.
Mhm.
So I did that for about 2 years and have since been working at JLL. Throughout the business, throughout my time at JLL, I've rotated through different teams. So I've been in our corporate solutions team, providing solutions to our corporate clients around their property needs. I've also been in our valuation team. So I was valuing residential and commercial property all
Mhm.
across the UK. So I've done anything from like 300 plus unit development appraisals to your high-end Mayfair flat, £15 million flat valuation, to an industrial unit in Chorley valuation, high street retail. So I've kind of done it all, and I've had a varied background. Although I'm no longer in a valuation team per se, on a day-to-day basis, whenever I am assessing an investment property, I am carrying out a valuation on that particular property to figure out what kind of returns it can provide the clients that we work with at JLL.
So it could be argued that people who are property owners or who are looking to buy will have a glorified view, and I mean that in the nicest sense, in terms of what that property is worth, or the benefits that it provides from a finance standpoint, from an everything standpoint. Valuers have a very different perception. And what is it? What are the core things that you would typically look for? And I assume they will be slightly different based upon whether it's a residential, commercial, or you're looking at it from an investor standpoint. How do you approach it? What do you look for? And are there any specific areas that you will focus on for each of those?
So I think I'll start with the residential valuation, which is slightly, oh gosh, I'm going to get a lot of residential valuers chewing my neck on this, but I'd say it's slightly easier to kind of comprehend or understand than commercial. So with residential, we are looking for, it depends, first of all, on the purpose of the valuation. Often, if you are a valuer going in to value a property, it's more often than not going to be for loan security, so for a bank. And therefore, our client and our duty of care is to that lender. I often, when I was in our valuation team, I'd go to site to do an inspection, and the borrower would meet me, on site, or meet us on site, and would have put together a valuation pack and hand that over to us, which is useful to a certain extent. But I think a lot of investors feel or think that the valuation pack could help sway the valuer or help push the valuer in their favor, but that's not the case, really. I think, if anything, if you want to provide us with information to help the valuation, it's seeing sort of the before and afters, knowing your plans for the property, exactly how you're going to build it out. If it is a development, what is it existing? What are you planning to build out? We need the floor areas essentially, and actual measurements to then be able to go out and look for comparable evidence and be able to come up with that comparable evidence ourselves. If we have you giving us what you perceive to be, comparable evidence, we're not going to just take that at face value and go forward with our valuation. We're always going to do our own research, and sometimes it can be, so I've had instances in the past when I've had borrowers kind of harrowing us, calling us constantly, what's the valuation? Where do you think you're going to end up at? And we're like, we can't speak to you because you're not our client. The bank or the lender is our client. So yeah, I think we look for what is it in its current state? What is it going to be? And what would it, what are the comparables in that area for what you're trying to build? Are there even any comparables? If you're building a block of all 1-bed flats, but in the area there's only been 2- and 3-bed flats sold, we'd be advising our client, the bank, saying, well, yes, it might be suitable for loan security, but the worry or concern is, if this borrower is to default and the bank has to then sell the units, they might struggle to sell it if the market in that area is more for 2- and 3-bed flats than it is for 1-bed. So make sure you do your research and understand what is actually selling and what people are looking for in that area, rather than just building the most units that you can and trying to squish as many units onto the site to increase the GDV, but not realizing that actually once you've got all those units built, is there anyone who's actually going to buy it? So yeah, those are the kind of things we'd put into our report. We'd also do sort of further DD in terms of understanding, is it in a conservation area? What is the local sort of plan or the local authorities plan for that area? Will it achieve planning? if it hasn't yet got planning. These are like, which we're trying to let the bank know of all the possible pitfalls, essentially, and trying to highlight those. So if you are an investor, you should be also considering those when you are analysing your deals before buying.
And things like cash flow, exit strategies, if you're doing a build to sell, and all of those will also come into play, won't they?
Exactly. And timeline as well. You know, I think most people know that any small change in timeline can really impact your cash flow in terms of finance, cost of borrowing, any small changes in build costs and the like. So we always speak to our in-house building surveyors to understand whether they think that the build cost that the borrower thinks they can build it for is actually in fact what the market could build it for, because that's what our main concern is. We're looking at, anytime we appraise anything, if you're doing a valuation, you're looking at it from a market perspective, and you're saying to the bank, essentially, our whole report is essentially telling the bank, if this borrower is to default, can you as the bank step in and either complete the development and sell it on and get your money back, or can another developer come in and buy the site and complete it? And if they do, what are they going to build it for? Not necessarily what the borrower is going to build it for currently.
Yeah, that makes a lot of sense. And moving on to commercial, a lot of that will be the same. Are there any sort of or what are the variances when you're looking at commercial?
The main variance is that commercial, we are looking at it from an investment perspective. So we're capitalizing the income using an appropriate yield. And I think it's difficult for just a regular investor to get your hands on, and even as a valuer, trying to find or understand what the yields are in that particular area can sometimes be quite difficult. We're fortunate that we've got access to commercial transactional data, which we're then able to analyze and use as our comparable evidence. But your regular investor, unless they subscribe to things like CoStar or EG, they won't be able to understand what the actual yields are. Sorry, are you
it's fine. What we'll do is we'll just make a note of it, so it's fine. I'll say, so once you finish the next bit, then I'll just say, oh, you probably heard.
Move to a different part of the house, I can do that.
What would you prefer?
I think it's probably best if I move, because I don't know how loud the bang is going to get.
All right, that's fine. So you might have noticed that Faith's background has changed, and that's because someone's actually doing building works, and so she's had to move location, but we're going to carry on anyway. So Faith, we've talked about residential. I want to move on to commercial, and there must be differences between the work that you do for a residential valuation compared to commercial. Can you talk to me a little bit about that?
Yeah, sure. I mean, the principles are still the same. If you are valuing something on behalf of a bank, you are very much looking at all aspects that could impact the value of what the bank is lending on the property. But the difference with commercial is that you're not looking at it from a comparable basis. You're actually looking at it from a yield perspective. So you're looking at commercial transactional evidence, which we have access to. So when you work at one of the sort of real estate firms, you'll have access to things like CoStar or EG, which provide the transactional evidence, which we then use as our comparables, and then we apply an appropriate yield to the rental income of that property, which is the capitalization, and that's how we arrive at the capital value of that commercial unit. Now, as a regular investor, you might not necessarily have access to those systems, so sometimes it can be difficult to apply the appropriate yield, and there have been instances where we'll go out and value a unit and the borrower is like, well, actually I don't think it's worth that, or I don't think you've used the correct yield. And then they always say that valuation is an art, not a science. It's very much one valuer could value something one way, another could have a completely different opinion. It's all very much about looking at, okay, what are the risks associated with the property? Is this property particularly, is it in a better or worse condition than its sort of comparable evidence? Is it, how long is the lease term? You know, the tenant that's in there, what's the covenant of the tenant in the property? Is it, you know, if you're, for example, when we look at covenants, we go on to, we print out and download credit risk reports, essentially, and we look at how credible that company is, whoever the tenant is in the building. Right. So if you are an investor buying a commercial unit on a secondary retail parade, and you've got, you know, Joe Blogg's retail store versus Apple is obviously going to be the better covenant because it's better known and it's just a bigger company, and therefore the risk associated with a store that has Apple as a tenant is going to be a lot less, and therefore the yield would be, the yield that's applied would reflect that. So I think there's a lot of nuances that we look at from a commercial perspective. We go much more into detail than we do when we look at resi.
And what about when you're evaluating projects or sites or opportunities for investors? Are there further nuances still?
Yes, there are. So when you're looking at, so I've talked a lot about valuing from a bank lending perspective, which is obviously a lot more, there's a lot more diligence associated with it, because obviously as a registered valuer, you're then liable if something goes wrong and you've said that the property is suitable for loan security. You know, the bank could basically come back to you and say, well, it wasn't. But when you're looking at it from an investor point of view, so if someone is purchasing a building and we're running a financial appraisal on it, we first need to understand what the investor is looking to get out of the property, what type of return they're looking for. So most investors will have an internal rate of return that they need to hit. So that will be usually a percentage. So whether that's 5%, 7%, 11%, and depending on their risk appetite, that return will be slightly different. So we look at investors in different camps. So we look at core investors, who are people like your pension funds who need stable, steady income. They're very risk averse. They just want something, they want to invest in a property that's going to provide them with long-term income, and that doesn't require a lot of work. On the opposite scale, you have your value add or your opportunistic investors who will be specifically looking for distressed assets or properties that need or require a lot more asset management. So maybe the lease terms in the building are coming to an end, and they can bring someone in there, get new tenants in there, increase the rent by £10 per square foot or whatever, and then be able to flip it onto a new investor who would just want the property on a long-term income basis. So once we understand the return requirement, we can then appraise the property on that basis. So if that property that we're looking at doesn't hit the benchmark that the particular client is after, whether they're risk averse or want risk, then we'll be able to say, actually, this property isn't for you. You'd be better off buying this property instead, etc. So we're very much looking at it on what return requirements it can hit. So what I've done in my own personal sort of property investments, and I advise when I speak to other property investors alike, I say to them, when you're looking at a deal, look at it. You have to have a house view as to what return you want to hit. So when you're analysing deals, if you don't hit that return, move on. Don't get too emotionally invested in that one deal, and don't try and tweak the numbers and make it work so it can get to your return requirement. Because if it's not getting there, it's probably not worth it, and it's not for you.
Yeah. So with regards to investors, do investors consider a range of return?
Yes, yeah, they do. I think it's important to do so. They usually have their minimum hurdle that they need to hit for it to be a viable investment opportunity for them. But often if the market does change significantly, in any given moment in time during a year, at the end of the day, they often they have a pot of cash that they need to invest. For example, a pension fund, they're going to have to reinvest that money somewhere, somehow. So if there aren't any opportunities that meet their minimum requirements, then it's on us as agents to present to them other opportunities that they can put their money into to get them some level of return until the market picks back up again. So yeah, I think it's always important to have that range and to be flexible, particularly in times like this. You know, nobody could have expected the pandemic to hit as
Absolutely.
bad as it has. Yeah.
And what about the valuations themselves? So there are different types of valuations, aren't there? You've got a market value, you've got a 30-day, 60-day fire sale. Can you talk a little bit about those and the differences between them?
So from a valuation perspective, there's different terms in terms of value. So often if we're valuing something on behalf of a bank, we're looking at the market value, hence why it's very much a market appraisal. We're looking at what the market would pay for something and what the market would, if, for example, in a development perspective, what the market would build that particular development for. If we're valuing something for the client is not the bank, but is actually the owner, we might be doing a valuation of that asset for just for their accounts purposes. You know, so there's different ways in which we would value something depending on who the client is and what the end game is in terms of understanding that value, the value of the property to that person.
Okay. And you talked right at the beginning about COVID. So let's come back to that. So in the current environment, so we're 2.5 months into this now, or thereabouts. What are you seeing from a valuation standpoint? Because actually, at the moment, the future is still quite unknown, isn't it? We're not even out of it in terms of being able to sort of start getting back on track. So how does that affect valuations, do you think?
Well, the main impact was the fact that we weren't able to actually go out and inspect to be able to carry out the valuation. So we were having to rely on information provided to us by the owner of the property, but then also doing a desktop basis and evaluation essentially, and then being able to we had to basically caveat in all valuation reports, you know, there's material uncertainty here because we haven't been able to physically go out and inspect the property. Therefore, yes, this is our opinion on what the value of the property is. However, until we have opportunity to actually go out and value it, we won't be, 100% certain. So it's then on the lender to choose whether they proceed with lending on that basis. I think in terms of because the market, and often, when you are valuing something, you're looking at comparables in the market, and if there are no transactions happening, which there, transactions have been down during lockdown, it's then hard for us to find evidence to back up that valuation. We'll have to be, instead of looking at the sort of the last 6 months of transactions in that particular area, we're then going to have to look a little bit further back, and we're almost doing sort of finger in the air type analysis, and we have to make sure that the bank is aware that the evidence that we're looking at isn't as recent as we would normally like it to be when looking at a valuation. So yeah, I think it's impacted greatly, and it'll be interesting to see how valuations will be carried out going forward, whether desktop valuations will continue to be a thing where, if there's limitations on getting onto site, will a lender consider doing a desktop valuation initially until the valuer can make it on site, just to speed things along a little bit in terms of getting, lending? I don't know, but yeah, that's essentially what we've seen and how it's impacted valuations.
We have been asked whether or not we know anyone who's using drones, which I absolutely love. I love that idea. Obviously, you can't go and sort of poke a wall or anything like that, but actually being able to see the site from different perspectives is quite interesting.
Yeah.
Yeah, so I'm keeping an eye out for that, and obviously virtual reality. So they're my two core things, which I'm sort of very interested in. And Faith, you're helping investors actually evaluate deals, aren't you? Can you tell me a little bit about that?
Yes, yeah. I'm offering and helping other investors. You know, it started off with just my friends really who were looking at going from doing traditional buy-to-lets, moving more into the development space, and they didn't really understand how to analyze a deal from a development perspective. So I've been able to kind of help and assist them in understanding, okay, how do you arrive at the GDV? How do you search for or get to what your build costs might be? What are the other cost assumptions that you must include? You know, marketing, finance, professional fees, all of that kind of thing, and allowing them to then arrive at their profit. And then, yeah, so I've been able to kind of help and assist in that sense.
That's wonderful. And you have actually produced a download which is focused on analysing deals and what you look for, which people can actually access, can't they?
Yes, exactly. It's it's a two-page document essentially, just showing you how, from a valuer's perspective and from someone who works in the industry, the corporate side of the industry, how I look at the deals that I do, just as a way to provide a bit more insight and support and help other property investors who might be just starting out in the space, or they might already be in the space but might want to know, okay, well, how would a valuer look at it? Because it could be that you're analysing all these deals, but then when your lender's valuer goes out to look at it, they're coming back with a completely different answer, and then your deal's no longer viable. So just being able to understand what is it that a valuer sees that maybe you're not seeing, or maybe you're not being as conservative, maybe. I think that could be really helpful. So yeah, it's a downloadable document, and I'd encourage anyone to take a read.
Actually, that's really interesting because that will shortcut the process, won't it? Because
Yeah.
if you know what potentially valuers look for, then actually you can get closer to that position from day one when you're
Yes.
evaluating your own deals. I think that's wonderful. And the link is in the description below, so you can download that. And obviously that has your contact details on it as well, doesn't it, Faith?
Yes,
If people want to find out more or have a conversation with you, they can contact you through that.
yes, they can.
Yeah, perfect.
Yeah.
Thank you so much. I really appreciate your time.
Thank you.
It's been enlightening. I love doing these interviews. I always pick some new tips up as well, and have done again here.
Yeah.
Thank you so much.
Thank you.